if you look at 2008, when the stock market crashed, started going down, it bottomed out in 2009, and then it started going up. So the 2008 crash happened, started in 2007, and it bottomed in 2009, and then it goes up. And by 2012, the stock market had fully recovered. But in 2012, that was when the housing market bottomed. So the housing market bottomed 3 years after the stock market. And why? Well, the stock market has a lot of panic, it has a lot of emotions, and you can oversell very quickly because it's all emotions, right? When you see the headlines on the news talking about what's happening in the markets, people get scared. And then you see assets go down, and you go, oh my God, my assets down 30%, I want to sell my stocks, and then it keeps going down. And so it's a very emotional driven, and it can happen essentially in the blink of an eye because you can buy and sell stocks in a second. The housing market doesn't work like that. The housing market has a much longer lag time because it can take easily 30 to 90 days to buy and sell a home. And so you just understand that the housing market moves significantly slower. And so if interest rates, say, went up to 10%, I have a strong hunch that the stock market would get hurt bad. And I think there would be a lot of opportunity there. But
in the stock market?
In the stock market.
To invest then in the stock market,
yes. And that's if you believe in the American economy. I do. If you think the American economy is going to be strong in 10 years, 20 years, then there's opportunity there for you. And so what that would mean for me is looking for strong companies that are not going into bankruptcy, that I can find opportunity to purchase. And if you're not interested in investing in individual companies, if you're not willing to spend the time doing that, because I think the majority of people should not be investing in individual companies because they're not willing to put in the time, effort, research, and have the psychology to do that, then you can just look into an ETF that gives you exposure to the general stock market, the S&P 500, which is the biggest 500 companies on the stock market. And now you're just investing in a piece of America, and you're able to buy it at a discounted price. So that's what I would say there. And then if you're talking about cryptocurrency, you have to first, I'm not here to tell you believe in crypto or don't believe in crypto. That's not what I'm here to do. If you believe in crypto, I invest in crypto. If you believe in the technology, you have to be willing to weather the storm. And you have to be willing to understand that, price makes changes the sentiment of crypto. Because when prices of crypto go down, people think crypto is fake. It doesn't matter. When prices of crypto go up, people think, oh, it's the future. And so if you really want to be an investor, you have to be able to cut through that emotion and cut through the noise and understand, okay, I like the blockchain, I like the technology. I'm not investing in the meme stuff. I'm investing in something that has actual value, that can actually create change, and then that can be an investment for you. Big mistake that happens, and this happened in big part in 2020, is you can't time the market. Nobody knows when the bottom is. And it doesn't make sense trying to time the bottom. When the 2020 crash happened, I was making videos on YouTube. And one of the things that I was saying when the market was just collapsing, I said, look, here's what I'm doing. I'm buying on the way down. I buy in phases. I don't know when the bottom is, so I'm just gonna keep buying when I do my research now to find the good companies and the investments that I want to own. So I'd spend my time when times are good to find the good investments. I already know what I want. Now all I'm looking for is a good price. I'm looking for a good entry point. When the price goes down, hey, it's on sale, I'm gonna buy. If it goes down further, I'm gonna buy even more. So every time it goes down 10 to 15%, I buy, and I buy more aggressively as it goes lower. And when I was making those videos, I got flooded with comments of people saying, why would you buy now? The market is collapsing, it's gonna go way further, wait for it to drop. And I kept saying, look, I can't predict the future. I don't know when the bottom is. I'm not trying to time the bottom. I don't know how long we're gonna be at the bottom. What happened? The Fed opened up the money printer, the X factor I like to call it, and it shot back up. So if you were trying to time the bottom, what happened? You missed the opportunity to buy, because then it starts going up and you say, no, it's too high, I don't wanna buy. And then it keeps going higher and higher and higher, and you just missed it. So instead of trying to perfectly time the market, either do a dollar cost average system where every week you just buy a little bit of your investments that you like, whether the market's up or down, doesn't matter, passive, consistent, automatic, you let it do its thing. Or if you want to be more active and you want to look and research the companies and the investments that you want, make your list and just look for a good buying opportunity and buy on the way down.